Imagine a company whose revenues are growing at like nearly 170% a year,
Right?
and their profit margins are suddenly rivaling the most lucrative software monopolies on the planet. I mean, they essentially hold the physical keys to the entire artificial intelligence revolution.
You'd think the market would be absolutely in love with them.
Exactly. You would think the market is pricing this company at a massive premium, treating it like the darling of Wall Street. Yet, inexplicably, the market is currently valuing it like a boring legacy hardware manufacturer that's just, waiting for the other shoe to drop.
It really is one of the most glaring pricing disconnects we've seen in the tech sector in a very long time. I mean, investors seem to be looking at a completely different company than the one actually operating in the physical world right now.
Yeah, and that's exactly why we're doing this. Today, for you listening, we are doing a deep dive into an incredibly detailed investment thesis on Micron technology.
And it's a fascinating one.
It really is. Our mission here is to unpack how a company that's historically known for highly cyclical boom and bust memory chips is currently behaving like a secular AI infrastructure leader.
Right, because Wall Street might be fundamentally mispricing what could be the single most important bottleneck in the 21st century economy.
Exactly. Whether you are actively managing a portfolio or you're just trying to make sense of how global tech supply chains are shifting beneath our feet, this deep dive is going to be incredibly relevant.
For sure. But to understand the mispricing, we really have to look at how deeply ingrained the old narrative is.
The muscle memory.
Yeah, exactly. For decades, memory manufacturing was just a brutal business. Companies would build these massive fabrication plants, they'd flood the market with commodity chips, and then prices would crash.
And margins would just evaporate entirely.
Right. So the market has muscle memory for that exact cycle. They're waiting for the crash.
Okay, let's unpack this then, because the fundamental financial metrics Micron is posting right now present a wild paradox. I was looking at their trailing 12-month year-over-year revenue growth, and it is sitting at 166.98%.
Triple digits. It's massive.
Yeah, triple digits. But it's the margins that really made me do a double take. Gross margin is at 72.57%, and net margin is almost 56%.
Which is unheard of for hardware.
Right. For every dollar they take in, nearly 56 cents is pure profit. In hardware manufacturing, that feels almost illegal. They have a market cap of around $111 billion, generating huge operating cash flow, and earnings per share are at $44.17.
But then you look at the valuation.
Yeah, here is the paradox. With all of that explosive growth, their trailing PE ratio is just 22 times.
Which is astonishingly low. I mean, when you look at other AI infrastructure giants, you routinely see price-to-earnings multiples in the 50s, 60s, or even higher.
Yeah, NVIDIA, AMD, those guys.
Exactly. So a 22 multiple suggests the market is pricing in an imminent catastrophic collapse in earnings. Investors see that 72% gross margin, and their immediate reaction is, this is a cyclical peak, the demand is going to dry up, and they're going to be left holding the bag.
So what does this actually mean for you as an investor? If they're growing revenues at 167%, why is the PE stuck at 22? Is the broader market just refusing to believe this growth is structural?
That's exactly it. The market is assuming that Micron is simply selling more of the same old product at a temporarily inflated price.
But that's not true.
Not at all. That fundamentally misunderstands what is actually rolling off their assembly lines right now. We are not looking at a cyclical rebound driven by volume. We're witnessing a massive structural product mix shift.
Meaning they're manufacturing entirely different, far more complex technology than they were even, say, 5 years ago.
Precisely. They have pivoted aggressively toward high bandwidth memory, specifically a generation called HBM3E, alongside specialized data center DRAM.
And these aren't just normal memory sticks.
No, these are not the basic memory sticks you put in a desktop computer. These are hyper-advanced components that are absolutely essential for AI accelerators. You physically cannot train or run massive AI language models without them.
Okay, here's where I want to make sure we truly understand the technology, because I think the term high bandwidth memory just gets thrown around as a buzzword a lot.
Oh, all the time.
To understand HBM3E, you can't think of traditional flat computer chips laid out next to each other on a wide motherboard. With the old architecture, data had to travel relatively long physical distances across the board.
Which creates heat and slows everything down.
Exactly. HBM3E changes the physical geometry entirely. They're literally stacking memory dies vertically on top of each other, almost like a high-rise building, and running microscopic wires, they call them through silicon vias, straight down through the floors.
That's a great way to picture it.
So the data doesn't have to take a long highway across the motherboard, right? It just takes the high-speed elevator down to the processor.
That high-rise elevator analogy perfectly captures the architectural leap. And because the data has a shorter distance to travel, it can move exponentially faster while consuming a fraction of the power.
And power is everything right now.
Power consumption is the ultimate bottleneck in the modern data center. If your chip uses less power and generates less heat, it allows the entire server rack to operate more efficiently.
Which saves the cloud providers billions in electricity and cooling costs over the lifespan of a data center.
Exactly. And because this high-rise architecture is so complex to manufacture, Micron can charge a massive premium for it.
So it's like, think of Micron like a local bakery that used to make pennies on the dollar selling basic white bread. But suddenly they became the exclusive supplier of $1,000 wedding cakes to billionaires.
Yeah, and to take that bakery concept a step further, there are only 3 bakeries on the planet capable of baking that specific cake.
It's an oligopoly.
It is. The advanced memory industry is a tight oligopoly consisting of Micron, Samsung, and SK Hynix. The barriers to entry are practically insurmountable for a new player. You need tens of billions of dollars and decades of specialized IP just to get in the game.
But even within that 3-player group, Micron is pulling ahead.
They are. Currently, Micron has carved out a distinct technological edge. Their HBM3E product has demonstrated superior power efficiency compared to Samsung's competing offering.
And this gives them what the deep dive sources call a design win advantage with the hyperscalers, the massive tech companies building these AI data centers. Meaning, Micron gets baked into the fundamental architecture of the server from day one.
And the implications of those design wins are huge because they create incredibly high switching costs.
Once you're in, you're in.
Exactly. Once a memory supplier is qualified and physically integrated into a specific AI accelerator package, the time, capital, and engineering resources required to swap them out for a competitor are just astronomical.
Right. A hyperscaler isn't going to halt their entire AI development pipeline just to save a few pennies on a different memory supplier.
Never. Once Micron is in, that revenue stream is remarkably sticky.
But if their technological moat is this impenetrable and the hyperscalers are locked in, the hesitation from Wall Street might stem from a different fear altogether.
The fear of a single point of failure.
Yeah. What if the cloud providers themselves suddenly stop buying? What if the data center build-out hits a wall? If you are an investor, you don't want to see a company entirely reliant on a single sector.
Which is totally fair. But the sources highlight a massive new development that proves Micron is securing entirely new avenues of demand outside the data center.
Diversifying the growth engine.
Diversification is the only way to prove to the market that this is a secular trend and not just a localized tech bubble. And the most glaring evidence of that diversification is their recently secured memory chip allocation agreement with Tesla.
Oh, wow, yeah. We are talking about a major supply agreement that guarantees Tesla access to Micron's memory chips while locking in pricing.
It's a huge deal.
For you as an observer of the tech space, this changes the narrative completely. I mean, we often think of Tesla just as a car company. But if you look under the hood of modern autonomous vehicles, they're no longer just cars. They're essentially mobile AI data centers that happen to have wheels.
They really are. When you think about the processing power required for a vehicle to navigate a complex, chaotic city street in real time, the demands on the hardware are staggering.
Cameras, sensors, everything.
Yeah, the car's cameras and LiDAR sensors are pulling in gigabytes of unstructured visual data every single second. The onboard neural network has to process that data instantly to decide whether to brake for a pedestrian or swerve around a barrier.
Right, because latency in a data center might mean a slightly slower chatbot response.
But latency in a car moving at 60 miles an hour is a life or death failure.
Which means the vehicle needs instantaneous access to memory. The processors can only calculate as fast as the memory can feed them the data.
And that makes advanced memory the critical bottleneck for autonomous driving. And similar to the data centers we just talked about, the stickiness of this automotive supply is profound.
Because of the regulations, right?
Exactly. Automakers operate under intense regulatory and safety scrutiny. Once a specific memory component is validated and qualified for a vehicle platform, the automaker is not going to change it. Recertifying a new component is just too expensive and risky.
So if Micron is designed into the vehicle platform today, they are locked into that production run for the next 5 to 10 years.
Easily.
So does this Tesla contract foreshadow a wave of other automakers rushing to lock in memory supply before the available capacity is entirely eaten up by the AI data center?
I mean, it forces their hand.
Yeah.
If you are a legacy automaker trying to compete in the autonomous space, you cannot afford to be starved of memory components. The Tesla deal signals to the entire automotive industry that advanced memory is a scarce resource, and they need to secure their allocations immediately.
And it seems like the broader financial ecosystem is slowly waking up to this shift. The sources point out that financial outlets like Zacks have recently grouped Micron right alongside NVIDIA, AMD, and TSMC as a premier AI infrastructure play.
Yeah, the perception is shifting.
Even Jim Cramer recently flagged a specific metric in Micron's earnings report, noting that it completely defies traditional memory cyclicality. He called it an entirely different kind of business now.
And, when analysts start comparing a memory manufacturer to TSMC or NVIDIA, it indicates a fundamental re-rating of the company's place in the tech hierarchy.
The old rules just don't apply anymore.
They don't. Not when your product is the critical bottleneck for the two most transformative technologies of the decade: AI language models and autonomous vehicles.
Okay, so we've established the fundamental business strength. The company is generating massive cash flow. The 72% margins are driven by complex, high-rise architectures, and they're locking in sticky, multi-year contracts across entirely different industries. If the fundamentals are this strong, we need to look at how this is actually playing out on the stock chart and in the minds of institutional investors. Because let's be honest, we are operating in a highly chaotic macro environment right now.
We really are. But the technicals and the institutional sentiment data reveal how the big money is actually positioning itself, regardless of what the headlines say.
Let's look at the price action. The stock is currently trading around $990. Now, that is roughly 21% below its recent 52-week high of $1,255, which it hit back in late June of 2026.
But the larger trend is still massive.
Yeah, over the last 52 weeks, the overall return is a staggering 778%. But here's where it gets really interesting. The sources point out a massive point of divergence happening right now.
This is a huge signal.
Recently, on a day when the broader Dow Jones index plummeted 600 points amid heavy market panic, Micron actually rose 3.20%.
And a divergence of that magnitude is a vital signal for technical analysts. When a specific stock rises while the large cap indices are experiencing a heavy, broad-based sell-off, it indicates immense sector-specific strength.
It's bucking the trend.
Completely. The stock is decoupling from broader macro risk-off sentiment. Institutional investors are treating it as a safe haven within the tech sector. They're looking at the cash flow and deciding that the structural AI narrative is strong enough to override the general market fear.
And there is a lot of unseen market plumbing supporting that price floor. We have an article in the sources titled, "How Much Micron Do You Unknowingly Own?" which breaks down the mechanics of passive inflows.
Oh, the ETF effect.
Exactly. There are massive amounts of capital flowing into ETFs that are heavily concentrated in Micron. We're also seeing what the sources call whale alerts. Highly unusual, large-scale institutional options activity in the IT sector, which inherently captures Micron given its liquidity and volatility.
The mechanics of those passive ETF flows are crucial to understand. When a retail investor or a pension fund buys shares of a Vanguard Technology ETF or a thematic AI index fund, the algorithm managing that fund mechanically buys the underlying holdings.
It doesn't check the news.
It doesn't look at the news. It doesn't care about a Dow Jones sell-off. It just executes the purchase. And because Micron is increasingly heavily weighted in these indexes, it creates a systemic, continuous wave of buying pressure that sustains price momentum.
That makes perfect sense. It acts as a rising tide. But there is a piece of institutional data here that requires serious scrutiny.
Okay.
The deep dive highlights something called the Management Sentiment Purchasing Ratio, or MSPR. It is currently sitting at a perfect 100, which the system flags as strongly positive.
Sounds good so far.
Right. But when you look at the actual raw insider trading numbers over the trailing 90 days, there are 110 sells by corporate insiders versus only 3 buys.
I see where you're going with this.
That translates to a net negative of over 131,000 shares dumped by executives. I have to push back here. For anyone listening, if you see 110 executives hitting the sell button and only 3 deciding to buy, your alarm bells are going to ring. How can a ratio call that strongly positive? Isn't this just the C-suite cashing out at the top before the inevitable cyclical crash?
It is a very natural reaction to see those raw numbers and assume the worst, but we really have to contextualize how executive compensation actually works in the modern tech sector.
Okay, break it down.
Remember, this stock ran up nearly 778% over a 52-week period. For these executives, the vast majority of their net worth is tied up in restricted stock units and stock options. What you're seeing with those 110 sell transactions is entirely standard 10b5-1 executive option exercising.
Let's clarify that for the listener, because the mechanics matter. These aren't executives waking up, looking at the stock price on their phone, and deciding to panic sell.
Far from it. A 10b5-1 plan is a pre-scheduled automated selling program. Executives set these up months, sometimes years, in advance. They mandate that if the stock hits a certain price target, a specific number of shares are automatically sold.
Just mechanically executing?
Exactly. This is done specifically to avoid any accusations of insider trading based on non-public information. So when a stock skyrockets 778%, all of those preset price targets get triggered, and the automated selling executes. It is simply wealth diversification and risk management. They're essentially just taking a portion of their paycheck.
Which explains why the algorithm weighs the sentiment the way it does. The automated selling lacks conviction because it was scheduled way in the past. But what about those 3 buys?
That is the crucial variable right there. The executives executing those 3 buys are taking their own liquid cash and actively choosing to buy shares on the open market at these elevated price levels.
Yeah, the SPR algorithm weighs the conviction of the transaction. 3 active, high-conviction open market buys signal far more confidence in the company's future than 110 automated pre-scheduled diversification sells.
Okay, the conviction argument definitely holds up when you explain the plumbing behind it, but my skepticism provides the perfect bridge to examine the bear case objectively. Because despite the incredibly strong fundamental numbers, this is not a risk-free endeavor. The sources explicitly note that this stock has a beta of 2.22.
And a beta of 2.22 implies extreme volatility. Simply put, this stock will amplify the movements of the broader market by more than double.
So it's a roller coaster.
A roller coaster without a seatbelt. If the S&P 500 rallies, Micron will likely surge. But if the broader market panics and drops precipitously, Micron will fall hard and fast, regardless of how strong its internal fundamentals are.
So what actually triggers that downward volatility? What are the tangible risks that could derail this thesis? Risk number 1 brings us back to the historical ghost of memory cyclicality. The gross margin is currently sitting at an extraordinary 72.57%. But the memory market is still an oligopoly.
Right.
What happens if this is just peak cycle conditions? If competitors like SK Hynix and Samsung drastically ramp up their own production of high bandwidth memory and flood the market in 2027, that pricing power will completely collapse.
It is the basic law of supply and demand. Right now, Micron is benefiting from a severe supply bottleneck. The AI industry needs more HBM3E than the 3 bakeries can physically produce, which allows Micron to dictate the price.
But they could just build more bakeries.
Exactly. But capital expenditures in this industry are massive. If SK Hynix and Samsung aggressively expand their fabrication capacity to win back market share, the oligopoly could devolve into a price war.
And then the margins compress.
Violently. If supply eclipses demand, those 72% margins will compress violently, and the 22x PE ratio will suddenly look entirely justified. The primary mitigating factor is that Micron's current technological lead provides a buffer, but, technology leads in semiconductors are rarely permanent.
And then there is risk number 2, which might be even more pressing in the immediate term: severe geopolitical and macro headwinds.
The real-world stuff.
Yeah. The deep dive sources ground us in the reality of late July 2026. Oil prices are eclipsing $100 a barrel amid major escalation tensions between Trump and Iran. Axios is reporting on discussions of massive retaliatory attacks. There is deep instability in the Middle East, specifically with tensions at the Temple Mount and Al-Aqsa compound disrupting global market focus. Now, obviously, we're not picking sides here. We're just reporting what the sources highlight regarding the market impact.
Analyzing this strictly from a macroeconomic and supply chain perspective, these geopolitical events create a severe risk-off environment for equities. Sustained oil prices over $100 a barrel act as a massive regressive tax on both everyday consumers and corporate balance sheets.
It just chokes the economy.
It heavily fuels inflationary pressures, which in turn raises the specter of a broader macro recession.
And if a macro recession hits, enterprise IT budgets are usually the first thing to get slashed. So, for you listening, are we relying too much on this AI supercycle narrative to protect us from basic macroeconomic gravity? If the cloud providers see their own enterprise clients pulling back spending because of $100 oil, they will stop buying GPUs, which means they stop buying Micron's memory chips.
Macroeconomic gravity almost always wins in the short term. If global supply chains freeze because of kinetic conflict, or if capital expenditures tighten, the massive data center build-outs could be significantly delayed.
But Micron does have some geographical advantages, right?
They do. The sources do highlight one key mitigating factor regarding supply chain risk. Micron has a very strong domestic manufacturing footprint. This shields it, relatively speaking, from some of the localized maritime or cross-border shocks that might instantly paralyze the competitor relying entirely on overseas fabrication.
But still.
But a domestic factory won't save the stock price if the end buyer simply pauses their orders due to a global recession.
So what does this all mean for you, the listener? Let's bring this deep dive to a close by synthesizing these two powerful competing forces. On one side of the scale, you have a company trading at a remarkably modest 22x PE ratio, while delivering a staggering 167% revenue growth and 56% net margins.
Driven by that highly complex, vertically stacked product architecture.
Yes, the high-rise elevator. You have a massive new automotive growth engine locked in with Tesla, and a stock showing the technical strength to buck 600-point market drop days. Heavily supported by passive ETF flows. I mean, it screams secular AI later.
Yet on the other side of the scale, you have the persistent historical threat of memory cycles, where competitors could easily flood the market by 2027. You have oil at $100 a barrel, rising geopolitical tensions in the Middle East threatening global supply chains, and a stock with a beta of 2.22 that ensures any broad market panic will be amplified violently.
So for you navigating this space, it is crucial to keep an eye on the upcoming catalyst calendar. The late summer FQ4 earnings report will be the absolute primary validation point for whether these 72% gross margins are actually sustainable or just a cyclical peak.
That's going to be a huge reveal.
And looking further out into Q3 and Q4 of 2026, the qualification milestones for their next-generation HBM4 chips will show us if they can maintain that critical technological edge over Samsung and SK Hynix.
The execution on those specific catalysts will determine if that $12,255 high from June was a permanent ceiling or simply a stepping stone in a much larger multi-year repricing of the company.
I want to leave you with a broader philosophical question to ponder on your own, something that builds on the architectural shifts we discussed today.
I love this thought.
As AI compute demands continue to scale exponentially, requiring more and more power, and as autonomous vehicles hit the roads, pulling in gigabytes of sensor data every second, is it possible that high-bandwidth memory, rather than the highly publicized GPUs or the processors themselves, will become the ultimate bottleneck of the 21st century?
It's a very real possibility.
If the ability to quickly access and process data becomes the single most scarce resource, and memory chips become the new oil powering our entire digital and physical infrastructure, how does that fundamentally reshape global power dynamics?
When the global economy transitions from being constrained by energy to being constrained by compute latency, the three companies that physically manufacture that memory hold leverage over nearly every other industry on Earth.
It redefines what a monopoly looks like. Something to think about the next time you hear someone write off a hardware company as just another cyclical trade.